Hey there, money-hungry viewers. Welcome back to another deep dive into the world of finance. Jim Cramer here, ready to break down a crucial part of the financial world. Bonds. You might have heard the term thrown around, but what exactly are bonds, and why should you care? They're not as flashy as stocks, but they're a vital ingredient in a balanced portfolio. Bonds provide stability and can act as a cushion during market volatility. Think of a bond like an IOU. When you purchase a bond, you're essentially lending money to an entity, be it a corporation or the government. You loan money to a company or the government, and they promise to pay you back with interest. This interest is typically paid at regular intervals, making bonds a reliable source of income. It's a steadier way to grow your money compared to the roller coaster ride of the stock market. While stocks can offer high returns, they come with high risks. Bonds, on the other hand, are generally considered safer. Now you might be thinking, Jim, why aren't we all buying bonds then? If they're so safe and reliable, what's the catch? Well, like any investment, bonds come with their own set of risks and rewards. Interest rate changes, inflation and credit risk are factors that can affect bond prices and returns. But first, let's dive deeper into why bonds are making headlines in 2024. With the current economic climate, bonds have become a hot topic. Governments and corporations are issuing more bonds to raise capital, and investors are looking for safer havens amidst market uncertainty. Historically, bonds have provided consistent returns over the long term. They might not make you rich overnight, but they can help preserve your wealth and provide steady income. There are various types of bonds to consider, such as government bonds, corporate bonds, and municipal bonds. Each comes with its own set of characteristics and risk levels. Understanding the bond market and its trends can help you make informed investment decisions. It's essential to diversify your portfolio and not put all your eggs in one basket. So, whether you're a seasoned investor or just starting, bonds can play a crucial role in your financial strategy. Stay tuned as we explore more about bonds and how they can benefit you in the long run. Thanks for watching, and remember, knowledge is power when it comes to investing. Until next time, keep learning and growing your financial acumen.
Listen up, because this is important. Bonds are often overlooked, but they play a crucial role in your investment portfolio. The year 2024 is shaping up to be a pivotal year for bonds. With the global economy in flux, understanding bonds can give you an edge. Why? Because interest rates are rising. This isn't just a minor uptick. It's a significant shift that could impact your financial future. When interest rates go up, new bonds are issued with higher yields, making them more attractive to investors. This is a fundamental concept that can help you make smarter investment decisions. And guess what? That makes existing bonds with lower yields less attractive. This shift can affect the overall bond market and your investment strategy. It's all about supply and demand, folks. When new bonds offer better returns, the demand for older, lower-yield bonds decreases, affecting their market value. So, if you're looking for a potentially less volatile investment than stocks in these uncertain economic times, bonds could be your ticket to financial stability. They offer a safer haven, especially when the stock market is unpredictable. But hold your horses. Before you go all in, let's talk about what kind of returns you can expect. Bonds typically offer lower returns compared to stocks, but they come with less risk. It's a trade-off that can provide balance to your portfolio. Diversification is key. By including bonds in your investment mix, you can mitigate risks and ensure more stable returns over time. Consult with a financial advisor to understand how bonds fit into your overall investment strategy. They can help you navigate the complexities of the bond market and make informed decisions. Remember, the bond market is influenced by various factors, including economic conditions, inflation rates, and government policies. Staying informed is crucial. As we move through 2024, keep an eye on these trends. Bonds could be the key to achieving your financial goals in this ever-changing economic landscape. So, take the time to understand bonds and how they can benefit you. Your future self will thank you for making informed, strategic investment choices today.
Now, let's talk numbers. Bond returns are measured by their yield, which is the interest rate you earn on your investment. In 2024, bond yields are expected to rise due to those increasing interest rates we talked about. This means you could potentially earn a higher return on your bond investments compared to recent years. But remember, higher yields usually come with higher risks. Don't worry, we'll break down the different types of bonds and their risks in the next section. Stay tuned.
First up, we've got government bonds, the safest bet in the bond market. These are issued by the US Treasury to fund government activities. Think of them as lending money to Uncle Sam himself. They're considered low risk because, well, the US government is unlikely to go bankrupt. But hey, even with low risk, you're still looking at relatively low returns. But hey, safety first, right?
Section 5, taking stock of corporate bonds. Next on the list, we've got corporate bonds. These are issued by companies to raise capital for expansion, research, or other business needs. Corporate bonds generally offer higher yields compared to government bonds because they come with higher risk. After all, companies are more likely to default on their debts than the US government. But don't let that scare you off. Investing in well-established companies with strong track records can still be a smart move. Just do your research. Section 6, municipal bonds for the community. Last but not least, we have municipal bonds. These are issued by state and local governments to fund public projects like schools, roads, and hospitals. Investing in municipal bonds is like investing in your community. Plus, they often come with tax advantages, making them an attractive option for investors in higher tax brackets. However, like any bond, their value can fluctuate based on interest rates and the financial health of the issuer. Section 7, bond market forecast, cloudy with a chance of returns. Now, let's gaze into my crystal ball and see what the future holds for the bond market in 2024. With interest rates on the rise, bond yields are expected to climb as well. This could present a good opportunity for investors looking for potentially higher returns. However, remember that bond prices and yields have an inverse relationship. When yields go up, prices go down, and vice versa. So while higher yields sound great, it's important to consider the potential for price volatility. Section 8, Bond Investing 101, a beginner's guide. Ready to jump into the world of bonds? Here are a few tips for beginners. Don't put all your eggs in one basket. Diversify your portfolio by investing in bonds with varying maturities and risk levels. Research different types of bonds and choose those that align with your financial goals and risk tolerance. Bond funds pool your money with other investors to purchase a diversified portfolio of bonds. This can be a good option for investors who want to spread their risk. Section 9, Bond Investing Don'ts, Avoiding Common Pitfalls. Now let's talk about what not to do when investing in bonds. Don't just focus on bonds with the highest yields. Remember, higher yields often come with higher risks. When interest rates rise, bond prices tend to fall. Be aware of this risk and how it can impact your investment. Bond prices can fluctuate in the short term, but over the long term they tend to be less volatile than stocks. Don't panic, sell your bonds if the market takes a dip. Section 10, the wrap-up bonds, your portfolio's best friend. So there you have it, folks. We've journeyed through the world of bonds and their pivotal role in your investment strategy. Bonds may not be as exciting as stocks, but they're a crucial part of a well-rounded investment portfolio. They act as a stabilizing force, providing balance and reducing volatility. Remember, bonds can provide a steady stream of income, potentially higher returns in a rising interest rate environment, and diversification to help mitigate risk. They are especially valuable during uncertain economic times, offering a safer haven compared to the more volatile stock market. Just remember to do your research, invest wisely, and stay informed about market trends. Keeping up with financial news and understanding the economic indicators that affect bond prices can make a significant difference in your investment outcomes. It's also important to understand bond ratings and how they impact the risk and return of your investments. Higher-rated bonds are generally safer but offer lower returns, while lower-rated bonds can offer higher returns but come with increased risk. And as always, consult with a financial advisor to determine the best investment strategy for your individual needs. They can help you navigate the complexities of the bond market and tailor a strategy that aligns with your financial goals. Stay mad, stay informed, and keep those portfolios growing. With the right mix of bonds and other assets, you can build a resilient portfolio that stands the test of time. Happy investing.